Okay, let us kick this off. Welcome everybody to probably one of our favorite events to do. It's kind of a large summary of a lot of where Gust sits in the startup ecosystem. I'm joined today by Pete, our CEO of Gust, to run through all the things you need to consider if you're actually going to raise a round from professional investors. And when we say professional investors, we largely mean angels and VCs, not just yourself or your uncle. There's a ton of stuff to get in order. There's a lot of checks on where your business is at and understanding the capital path that you are going to proceed. And we're going to cover that at a high level today. Pete has a new version of this presentation, which he promises me is improved and influenced by a lot of the learnings that we've had running our mission control program and years of running Gust Launch and helping angel groups, across the world make these things happen on a daily basis. So Pete's going to run through a presentation. I will manage the crowd in the Q&A. We're going to have a ton of questions. Yes, we're recording this. We will share the recording out a couple days after we wrap. But please use the Q&A functionality or the chat functionality to ask any questions along the way. We'll save some time at the end. And as always, this is not legal advice or tax advice. We are not lawyers. We're not your lawyers. We're not tax accountants. However, we have a lot of expertise in this space, so we can give you broad principles and best practices that generally apply to the vast majority of startups, but we'll also know when you should actually go and talk to a legal professional or a tax accountant to get specific answers to your situation. And I think that covers everything. So Pete, take it away.
All right, will do. Thanks for coming, everybody. So this is preparing to raise your first outside round. And as Ryan said, this is primarily going to be the first time that you're going to be raising from people you don't really know. So maybe you'll have taken in capital from friends and family, maybe investors that you know personally. But this is kind of all geared towards understanding the landscape as you go and actually approach people that you don't know to take in money for equity for the first time. And the goal here is really to save you time, save you money, and save you equity as you navigate this process. And the first thing that we're going to talk about is actually knowing your business and making sure that it aligns with investor expectations. And the big thing to realize first here is that 90% of the companies that get investment by angels or venture capitalists fail to return what they actually need them to return to make these things financially valuable. So VCs and angels rely on a small percentage of the companies that they invest in having outsized success to make up for all of the ones who don't actually make it. What that means for you when you're approaching these investors for the first time is understanding what their return expectations are. And for angel investors at kind of the seed stage and pre, they're expecting roughly a 30x return on the money invested. So that means every company that they're looking at, they have to credibly believe that you can get to a point where your business will 30x their investment. For early stage VCs, this is even bigger. If they're at the seed stage or earlier, they're typically looking for a company to have the ability to 100x their investment, which is a huge growth trajectory. And one way to conceptualize this is if you're going out to raise $1 million at a $5 million seed valuation, the people that you're talking to at a minimum are going to be expecting to understand how your business will achieve a $150 million plus exit. So as you get into this, it's really key to know the numbers, right? So you're talking to these people, you're understanding what their growth expectations are, and now you have to kind of present what you're asking for in terms of those growth expectations. And one of the key things for you to understand as a founder going out is really understanding how much money you need to do something kind of incredible, right? Every time investors put money into your company, they're expecting that you will have a plan to do something amazing with that money in terms of growth in the next 18 to 24 months. And your job as a founder first is to understand how much money you actually need. And one way you can do that is by financial modeling, better understanding your business, but you should really understand how much do I need to do something really big in terms of growth.
Before you move on, I've got a great question from Galen in the Q&A. Thank you for using the Q&A. 30x return over what period of time?
Oh, nice. All right. So typical exit scenarios for angels or VCs, they expect this stuff to be illiquid and be approaching an exit somewhere in between the range of 6 to 10 years. I think that is roughly the average, but these investors do know that their money will likely be illiquid for a long period of time. But the 10-year horizon is definitely in their minds. Typically, those are like fund timelines and things like that. So 6 to 10 years to an exit is typical expectation. There are some investors that have a thesis around companies that will get acquired in a shorter span of time, but typically their exit expectations and their multiples are adjusted based on that philosophy.
I think there's a really good point of clarification about the difference between angels and VC timelines. Angel investors usually are not running personal funds themselves that need to exit by a certain period of time. You know, they might be high net worth individuals, maybe they participate in some funds as well, but oftentimes angel money understands that private companies stay private for a while, et cetera. VC funds usually have a deadline. So when they're investing and deploying capital, they're looking at a return horizon usually fixed and demarcated by 10 years. So if you consider the VC pathway, know that the pressure of not just a successful business, but a successful business that has some exit potential in a given time frame is what's going to be important to VCs in particular.
Awesome. Thanks for clarifying that. So back to knowing numbers. First one is knowing how much money you actually need. And that's going to help in a couple ways, but the foremost way it's going to help is helping you understand who you can actually approach for that amount of money. So this infographic gives you a little bit of an idea of where these people lie in terms of the aggregate amount that they will invest. Right. So if you realize you need $100,000 to do something amazing or less, then you might not even be in angel territory, right? The amount that they will be able to invest in aggregate into your company might not even be enough for them to get the percentage ownership they're interested in. So looking at these numbers and understanding how much you need to raise to actually do something really cool gives you an idea of who you can approach. And that is a key thing to understand, who you're going to approach, how much money they are actually capable of investing in aggregate and around. The next thing to understand is how much of your company you are actually willing to give away to get that money. A lot of times when we talk about fundraising, we stress that fundraising is good to do in a few scenarios. One is when you absolutely need it. Unfortunately, at that point, you don't have the leverage. But the other is that you see a big opportunity, but you don't have the capital to pursue it, right? So usually that means the opportunity is timely, or it just requires some sort of upfront investment to capture that you don't have access to. So if you understand the amount of money that you need and you understand the really cool thing that you're going to do if you get that money, the next question to think about is, okay, how much of my company am I willing to sell to take advantage of that opportunity? We say this a lot often as well. Equity investment is some of the most expensive investment that you can take on. You are literally selling an ownership stake in your company. Somebody is coming onto your cap table who will have potential future control in decisions about how the company is run. Sometimes they will have board seats. They will participate in company governance. They are coming in to a collaborative effort to build something big together. So you have to understand, okay, how much ownership am I willing to give up to actually take this money in so I can take advantage of this big opportunity and achieve this awesome thing that I plan to achieve. And there are some good guidelines for this as well. In the early stages, roughly you're going to give up 6% of equity to those super early investors. And then it's going to range between 10 and 20% as you go on through future rounds. And this will have some impact on the next thing we talk about, which is how is valuation determined? Very often in the early stages, we see founders fretting over this quite a bit and trying to kind of backfill a valuation from numbers that don't have any concretion to them yet. Like, okay, I built this complicated financial model that says I'm going to make $10 billion in year 5, so my valuation should be Y. In reality, it is much more rooted in the percentages that investors need to get in a company to make the economics work for them. So if you know how much money you need and you know how much of your company you're willing to give up, and that is in the typical range of the investors that you're targeting at the stage of your company, you can use that to actually determine what the valuation is. And then you can compare that to market dynamics And that is much closer to how you're going to determine the valuation in these early rounds than anything that's based on revenue or revenue projections, because typically those things just don't exist yet.
And we're getting this in the chat as well as in some of the Q&A, which always comes up, is when we're looking at these stats, does this vary by industry? Does this vary by stage? Michael, we know Michael, who's in the aerospace industry, his feeling is like B rounds are more like 100 million, not 25 million for aerospace companies.
Yes. So these statistics that I'm showing in the infographics are based on aggregate data, and they are absolutely focused on your typical technology startup. So businesses that have high initial capital requirements, or businesses that are in health tech and medical device, there are some businesses that fall outside of these norms, right? The median and standard deviation just don't apply because the underlying economics of the industry are so different. However, conceptually, these things still apply. So even if the numbers aren't exactly right, for some industries, you can shift them to the right a little bit.
Yeah,
But yes, as you're going through this, don't just rely on aggregate industry-wide statistics. Look at statistics that are specific to your industry and your location.
Yeah, I think you will find most industries, it's just a multiple or a fraction of it. Like a B2B, I was putting this in chat, like B2B enterprise SaaS, you can get to profitability or revenue so quickly in that the startup cost could be much lower. So you could raise less money to get to the next stage of your company. While if you have to go through FDA regulation or you have to purchase super capital intensive property like buildings, planes, things like that, that will push it. But the one thing you don't want to do is just because you're a startup in a capital intensive industry does not mean that you sell off 60% of your company in your first round just because you need so much money. It adjusts both the valuation and the funds raised for the particular industry.
Yeah, and very often those industries also have alternative early stage funding sources. So for medical devices or anything in aerospace that also has military overlap, that's where a lot of the government grant programs come in. And that is how a lot of the early development of these things through kind of proof of concept and technological vetting can often happen. But with that caveat in mind, it is good to know roughly where valuations sit at different stages. So you can compare how much money you need and how much of your company you're willing to sell against the investor expectations based on the market. And these are rough approximations again, but good things to keep in mind. In that pre-seed territory, valuations are going to be roughly around $2 million. Really now we're seeing kind of pre-seed and seed anywhere between 2 and 5, and then on up from that. So if you are doing the calculation and you're saying, I need amount X, and I'm only willing to give up 2% of my company, and roughly investors are expecting 6 to 10% of my company at a valuation Z, and your numbers aren't lining up, then you have a fundamental mismatch with the capital that you're trying to attract. So you kind of have to go back and make sure what you are attempting to raise makes sense in terms of all of the dynamics. Even if you have a financial model that justifies it, nobody's going to buy it in the earliest stages unless it is actually based on real traction or revenue. Which feeds us into the next thing, traction. What traction is not. Um, Traction is not how much money you've raised. It's not a product you've built, a great idea, press, patents, team, or marketing. Traction purely is something outside your control that demonstrates your company's value to the market. So something where the market is actually pulling against your company and saying, yes, we want this and we're willing to pay for it. So paying customers, letters of intent, contracts, those are things that actually accumulate traction in your early stage company. And it's important to remember this because depending on how much money you need and how much you're willing to give away, traction is the leverage you get to use to sway those things and convince investors that they should come in at the terms that you're looking for, rather than the terms that they are looking for. And usually you're still going to have to work within those standard deviation bounds of the infographics we just looked at. But if you want to get to a little bit less equity for the same amount of money, traction is the number that you're actually going to use to justify that. And there's not much else that is going to help you if you want to negotiate towards the lower end of the percentage ownership you're giving up. So hopefully you've got great traction and your numbers line up with the market. The other thing that you need to understand as you go out is what the structure of these investments typically looks like. And the main thing to understand, and the thing that confuses a lot of people when they're getting started, is that early investors don't typically buy equity. When you start your company, it will typically have one class of shares called common stock, and that common stock will be used to incentivize the founding team, employees, contractors, advisors. Your option plan will be built on top of that common stock. But by and large, investors do not buy common stock because common stock does not have the rights and protections that investors are looking for in their investment. So in the earliest days, investors typically don't buy equity at all. So in hustle round, pre-seed and seed round, often what these investments will actually utilize is what we call convertible instruments. And largely these will be safes or convertible notes. And then once you get into rounds that start with the word series, those rounds will be conducted by actually creating a new class of shares for investors that have additional rights and protections in terms of liquidation preferences and participation rights and things like that, that will make them extra valuable. Those will be created at your funding round and sold to investors, but those investors still won't buy common stock. So if we dive in a little bit to what convertible instruments are. Now, you don't need to be a perfect expert on convertible instruments and how they work, but you should have a general understanding of how they're set up just so that you can navigate this stuff effectively. And essentially what they are is a way to bring money in now in exchange for future equity. The reason that they came about is because they are generally cheaper to close. There are less things to negotiate with investors, less bells and whistles, less knobs and sliders to move. So the back and forth between lawyers has to be less. And they do encode some investor rewards for the investors actually coming in early. And they are intended to convert when you actually go and sell shares at a future round in one of those Series C, Series A, or beyond. And generally, there are two types. The first is a safe, which actually came later, but it has dominated early stage industry for a while. So starting here, it stands for Simple Agreement for Future Equity. There is a standard form of it published by Y Combinator, who's actually the originator of the instrument. It is not debt, and overall, it is seen as relatively startup friendly. And the other common convertible instrument is the convertible note, which is debt. It actually came before the safe. It was largely developed on the East Coast and is still predominantly used by East Coast investors. And it does give investors some additional leverage that is absent from the safe. So they do have a debt window, like this functions like a loan. So there is a date at which the loan holders can say, we will either extend this debt and allow you to continue to operate, or we will have a conversation about what happens with the company. Now, typically, convertible note investors are not going to call down the debt at the maturity date and ask for their money back. Typically, this lever exists to give them the ability to have a conversation and participate in how the company is going to move forward. So even though this does exist as debt, typically the investors in this instrument are not treating it as such and not looking to just get their money back or their money back with interest. They're still interested in building a big company with you. They just have the additional lever of protection that gives them the ability to have a conversation and help steer the company in the case that things are not going to plan. Which brings us to valuation caps. And again, key here is don't overcomplicate it. It is not a point in time valuation of your company. Thinking back to what we just talked about in terms of valuations, it is primarily a negotiation between you and the investor for them to protect how much of the company that they are going to own. So it is not a 409A valuation. It does not value the common stock of your company. It is just a negotiation between you and the investor about how much they are going to own for the capital they're putting in. And the most important thing to understand for you as a startup founder as you interact with these instruments that have valuation caps is the difference between a pre-money valuation cap and a post-money valuation cap. Predominantly right now, the YC safe is a post-money valuation cap. So most instruments in industry are following that trend. And what a post-money valuation cap essentially does is that any investment you take in from investors on convertible instruments, whether they be safes or convertible notes, the ownership you are giving up accumulates. So if somebody owns 5% of your company based on the valuation cap and amount invested, and somebody else comes in and purchases 5% based on the valuation cap and amount invested, you've now sold 10% of the company. And all of those percentages of dilution are guaranteed for the investor. So when those instruments eventually convert, all of that dilution is going to be borne by the common stockholders. Prior to the most recent versions of the YC Safe, the valuation cap was pre-money, which meant that when other investors came in on convertible instruments, the other convertible note holders or safe holders, the other convertible investors, would also be diluted by that future convertible investment. Now, if all things are going well and you're hitting metrics and you bring in investment via convertible instruments, and then 18 to 24 months later, as planned, you are raising a round that starts with series, don't worry about it. You're in great shape. However, in a lot of cases, that doesn't happen. And the key thing to understand is you kind of want to have a good understanding of how much capital you might need in total to get to that first series round, because any additional bridge financing you take on above what you took on in that first convertible round is primarily going to dilute you, the common stockholders, not the early investors. All right, next up on structure, everybody's favorite, securities compliance. So convertible instruments are not equity, but they are securities. You are selling essentially a future equity interest, so the SEC does consider these things securities. Now, if you are raising from accredited investors and you are not generally soliciting, then you are roughly in pretty good shape in terms of complying with securities filings and exemptions. Accredited investors right now are people who make more than $200,000 a year, have a demonstrated history of doing that for the past 2 years, and an outlook to continue to do the same, or they have a net worth of $1 million, excluding their primary residence. These are big cudgels that the SEC uses to qualify people, so they can feel good about the fact that these people are not getting fleeced by early stage companies selling snake oil. There are some recent evolutions of this that are looking to qualify people who work for venture capital funds or qualify through taking some financial exams like the Series 7 or Series 65. So all of that stuff is still developing, but for now, the accredited investor standard really only covers high net worth individuals, people who work for VC funds, and people who are employed by financial advisor firms. On the general solicitation side, essentially what the SEC says is that you can't go out and yell from the tops of the hills in public forums to people who may not meet the accreditation standard that you are raising money. And if you try to skirt that by saying things like, we are looking for investors, or saying anything close to that on forums like Twitter or publicly, then you are likely running afoul of these requirements, and that can have some unintended consequences for the future viability of your fundraise and your company. So it is best to steer clear of that. And one thing that you want to be aware of as you navigate that is the concept of a pre-existing relationship, which is a really confusing term. But essentially what it means is if you have a pretty good idea that somebody qualifies as an accredited investor, then it is okay to talk to them or a group of them about the fact that you are raising funding without crossing the general solicitation line. Now, a pre-existing relationship, as far as the regulations are concerned, is more about developing an understanding of the fact that they meet the accreditation requirements than anything like actually meeting them in person. So you don't have to go and high five somebody or get a coffee with them to establish a pre-existing relationship, but you do have to have some mechanism by which you have vetted that they are very likely an accredited investor. And that could be their membership in a organized angel group. It could be the fact that they work for a VC. Or it could be an email chain or something else that establishes that fact where they have told you, yes, I do invest in startups and things like that. So that's the substance of that pre-existing relationship. And the last thing to keep in mind is regulation crowdfunding. A lot of times we see founders look at this and say like, oh, okay, regulation crowdfunding seems to be an avenue that I can bring in unaccredited investors in the early stage. In reality, going through the Reg CF process is actually relatively complicated, or not complicated, but it requires a lot of work. There are a lot of information filings. There are a lot of things to get set up. And primarily what Reg CF has turned out to be best for is for companies that have a base of users or an attachment of community that also happen to be good potential investors in their company. One great example is Mercury Bank that went on and allowed their users to become investors in the company, right? Because all of their users were like, yeah, Mercury Bank is awesome. I love it. I would love to contribute something back in exchange for equity. So it works really well if you have a community of people who may also be your users who would like to potentially invest in your company. It does not work particularly well if you just want to bring in a small amount of money from unaccredited investors in the early stages of the company. Generally, the timeline doesn't work. The amount of information that you actually have to provide and the process by which you'll work through this. And then the last sticking point is the closing requirements. So by and large, these platforms require you to raise at least 50K or find 50K in commitments before they will actually file the forms and officially start the fundraise. And if you only raise that much or raise slightly more than that, the amount you're going to pay to the platform for facilitating the raise plus the time you spend is going to undercut your ability to bring in a small amount of capital. Last piece on structuring that we'll talk about is your option pool. Usually when you bring in money, a decent amount of money from outside investors, it'll be the first time that you establish an option pool and start issuing options rather than common stock to incentivize the people who are building the company. Options give you the option to purchase stock in the future rather than giving you that stock at the time of the grant. And very often we'll see founders, again, look at statistics in the market and say like, okay, I will just create an option pool that is 20% because this blog post said so or this investor said so. It does make sense for you to actually base the size of your option pool on your hiring plan. So going very back to the beginning of this presentation, you should know how much money you need. Part of knowing how much money you need is knowing who you're actually going to employ with that money. And who you're going to employ should give you a pretty good idea of how much equity you're going to need to give to them in options to incentivize them. The closer you can size your option pool to the number of options you need or the amount of equity you need to incentivize the people you plan to hire with that money, the better off you will be. Because if you have a large number of options sitting in your option pool that are not actually allocated to people working on the company now, they will count against you in terms of dilution when you enter your next fundraising negotiation. So any overhang there is going to typically increase the dilution that the common stockholders are going to take in any fundraising event. And the broad framework to think about this is option pool, not an ocean, which I think was coined by maybe our good buddy Jose Ancer, whose blog posts we often refer to. And
I'll go find it.
one other thing to keep in mind is when you establish an option pool and you go to actually begin issuing options, that is when you are actually going to run into a valuation of your common stock. Typically, it's referred to as a 409A valuation because it allows you to comply with Section 409A of the IRS code. And basically, what that section allows for is if you get an external firm to give you a credible valuation of the strike price or the price per share of your common stock, then that gives you safe harbor from future investigation by the taxing authorities. So it allows you to lock in a relatively low price for stock options to incentivize your employees. And if there's a giant spread on that later, great, you have safe harbor that the strike price that you established was valid, and it is not up for debate by the taxing authorities. And one point of confusion that we see with founders a lot as they approach this stuff is conflating their 409A valuation with an investor-facing valuation. Typically, founders are incentivized to keep the price per share of their common stock relatively low in the beginning, so that they can effectively incentivize employees and maximize that spread. So strike price is low because the eventual price is going to be high, and the bigger the spread between those two numbers, the better it is for the early stage employees. And since investors don't typically buy common stock, since they buy preferred shares in rounds that start with series, and those shares typically have additional rights and protections, those shares are actually valued quite a bit higher than common stock until the company hits an inflection point where everything converts to common stock, like getting acquired or going public. So very, very often, the valuation of preferred shares will sit at up to 1.8x of what the common shares are. So if you go out and get a 409A valuation and it is lower than the valuation you would advocate for when fundraising, that is expected and likely good. And the 409A valuation is typically not going to have any bearing on the valuation you negotiate with investors.
I got a good relevant question for hanging on to that slide real quick. How soon should an option pool be established? When do you actually start needing 409A valuations and stock options rather than common?
So typically, this is tied to the value of common, right? So at the beginning of your company, you will typically have a strike price or a price per share of the common stock at a par value at a very significant amount. When you first start a company, it is arguably worth zero, right? Nothing has happened. There's no revenue. There's no value in it. So typically, a par value for common shares will be some number of zeros and a one. If you use Gust Launch, it'll be four zeros and a one. That means for a founder to come in and exchange cash for a relatively large sum of shares, it's a relatively small amount of cash. If I have 10 million shares and a par value of four zeros and a one, and I grant myself 5 million of those and I decide to pay cash, I'm going to pay the company $50. So it's very easy for me to buy in and establish my ownership of shares in the company and not have to take on a burdensome exchange of cash or an income tax burden. As the company gets bigger and accumulates value, arguably the price per share of the company goes up, even of the common stock. And there comes a point, usually in conjunction with a large financing, where you're hiring on a handful of W-2 employees, where the fact that you have a handful of employees and the fact that your common stock price has gotten up to a point that is significantly above par makes it make sense for you to establish an option pool so that the people coming in don't end up directly holding common stock shares. They have the option to buy, and it's advantageous for them because they don't have to pay cash for the common stock up front. They just have the option to purchase it in the future. So they don't have to pay cash for it, and they don't have to take a burdensome income tax hit if they can't pay cash for it.
Perfect.
All
Thank
right.
you.
So now
We've
that
got
we've got, oh,
I was just going to say we've got a bunch of Q&A questions that I've marked that have been like kind of somewhat out of order, so we will have time for them in the past. So if I've marked it as going to answer live, we're going to get to as many as we can once Pete gets through the rest of it. But there will be a couple that are answered in these last few slides, I think.
cool. So now that we kind of understand the structure, the last bit is actually convincing a professional investor to invest in you and your company. And really, this is all about building confidence in your business. And it brings us to the idea of safety and control. So when an investor purchases equity in your company in exchange for capital, they want to make sure that they are participants in an actual company that is organized as a collaborative effort to build something big, right? So they want assurances on decision making and their role in it in the company. They want to understand the finances. They want to understand who owns the company. They want to understand that the intellectual property belongs to the company, since that is the seat of value creation. They want to make sure that the team is properly incentivized. They want to understand their rights. And they want to make sure that the company is properly shielded from liability. And the way that you will typically do that is a Delaware C corporation. And we'll start with the C corporation piece, which is basically an ideal structure to organize a large number of people in pursuing a big risky bet. So on the C corporation side, limits liability and provides kind of collaboration and incentive features out of the box. Corporations, by their nature, are split up into shares. They provide that personal liability protection, and they have a structured set of governance principles that start with the officers of the company, who are then oversaw by the board of directors, who on top of that sit the shareholders. So there's a very clear governance structure that is set up that is common to all corporations. So it's a really good vehicle to build value into a shared enterprise. Now we'll move on to why Delaware. And the basic answer here is that even though a lot of states share a very similar corporate code to Delaware, Delaware has amassed a huge body of case law that gives investors confidence in how the law will actually be applied. So there's the letter of the law on the books, but in the US, the law is open to interpretation. It is interpreted through suits brought through the court system, and Delaware has dealt with more business cases than any other state and has a huge body of case law that gives people confidence. And once you've got that basic stuff set up and you've decided to incorporate in Delaware, basically your pre-investment diligence checklist for corporate formation stuff is that you have actually fully formed your corporation. That means you have officers, you have directors, and you have shareholders. Even if all of those levels of governance are only occupied by the founding team, it is important that you establish all of them so that you can legitimately take further corporate actions, like issuing future equity and taking on investment. You also want to make sure that all of the equity that you have promised to people in the company is actually granted in the company. This ensures that ownership is actually very, very clear. It makes sure that your team is aligned, and it gives investors confidence that everybody is set up to continue their participation in the company over a specific timeline. The next piece to watch out for is that everybody who is participating in the company should have explicitly assigned intellectual property to the company. So that means every founder who has been issued equity should have contributed all of their work product and intellectual property to the company through an agreement. Any contractors that you are working with should have signed as part of their contracting agreement that the intellectual property they generate and all work product they generate belongs specifically to the company. And last but not least, you will need a bank account established to actually close money, because investors are not going to wire money into your personal bank account. And if they do, and you commingle funds between your personal bank account and your business bank account, you will be in a world of hurt. So if you are navigating this, we can help. Real quick, we have a couple awesome offerings. One is software-based. It's a product we call Gus Launch. It takes care of all of the formation, equity management, IP assignment, early legal agreements, round planning, cap table, 409A valuations, and option plan. So literally all of the basic stuff that you need to get set up in place. It's built on best practices, established over many, many years of navigating the startup ecosystem. But in the process of building software, we realized that people still have questions no matter how good the software is. So we've recently launched a founder support offering called Mission Control, and we are thinking of it basically as a fractional co-founder for your startup. It is a community that is built on top of weekly virtual sessions and a knowledge base of early startup knowledge, and basically trying to get you to a point where you have a whole bunch of overwhelming questions about how to do this, to the point where you have a nice launchpad mechanism to achieve liftoff with your startup idea. So early stage support, weekly office hours, and nicely 40% off all Gus software, including Gus Launch. And I think that's it.
Sorry, I'm finishing up shameless plugs in the chat for that. So I'm throwing a link to Mission Control. I will say if you're just considering any of this and you're wandering on your path of starting a new venture, or you're in the middle of running a company of any given form, and all these questions and these terms tend to be coming up, but in different contexts, While Gus Launch is a perfect on the rails Delaware C Corp, SaaS tool that a lot of people, well, thousands and thousands of founders use and love, Mission Control is a great way to onboard and to really level set, get your capital path set, get, informed over, several weeks, if not months before pulling the trigger on something with more interesting implications. And like Pete said, 40% off Gus Launch kind of makes it a no-brainer as long as you're in the program because you save so much on that. Because we trust that you are well educated and well supported and can make corporate governance decisions using our tools in a much better way. All right, let's jump into the FAQ. We have tons. I'm going to be a little all over this place, Pete, but we have enough time that we should get through a lot.
Yeah.
Um, Brandon Wayback asked the 6% for pre-seed or seed round. Is that what he saw?
Yep. So 6% in the earliest stages is not entirely uncommon. General rule of thumb is somewhere between 10 and 20% per round.
Excellent. This is a crazy one. Anonymous asked, they got a C Corp, so they're trying to raise into 7 digits to get into production. And a colleague has offered to make introductions and wants a percentage of dollars raised if he introduces anybody as a finder's fee. He is not a security broker. Is this okay?
Okay or legal? Um, so, I mean, a lot of stuff in early stage startups, um, straddles the line between perfectly legal, perfectly dotted I's and crossed T's, and the necessity to get the capital necessary to start a business and allocate that capital wisely. Um, you know the regulations if you have cited them. So technically, no, it is not okay for anybody to take a percentage of the amount you raised unless they are a registered broker or dealer. Um, and I would say be hesitant about those services generally. If you don't have the cultivated connections to the investors that you need to get your business off the ground, it is very, very unlikely that somebody else who is outside the company and not a co-founding team member is just going to bring those and effectively drop them in your lap. Um, Now, again, highly regulated industries um, and industries that require a lot more capital upfront do have different paradigms and practices, but typically you will be in the purview of investment bankers who are registered broker dealers who will provide that service rather than upfront.
Yeah, and I would just say massive asterisk. If anybody wants a finder's fee for finding you investors, if it's an organization, if it's a colleague, if it's an individual, be mightily skeptical about that. Anybody who says, "Hey, pay to pitch my group of illustrious, investors who love writing checks, just give me $2,500," it's usually not legit. All right, we had some good questions back to comparables and setting your valuation. Would you ever use comparable companies as a metric for your own valuation? So if you're saying I'm raising this much and worth this much because this other company raised this much at this much.
Yeah, and essentially that's what the aggregate statistics are, right? So comparables is a way to do that. Uh, a couple things to be careful about. When you look at comparables, you have to look across all of the metrics that early stage investors are thinking about, right? So that's going to be team composition, proven track record, and traction, among other things. So if you are comparing yourself to a startup where the founders have significantly less or significantly more experience and a stronger track record than yours, that may not be a valid comparable for you because it's just not how the market dynamics work. The other thing to be careful about is stage differences. So if you are comparing yourself to a company that has real traction, revenue, and growth, and a killer team, and you're trying to justify an earlier stage valuation when you don't have those things, you're going to run into trouble. So you can't compare a future comparable to your present valuation necessarily.
And I would also say, I think your valuation should be more informed by your traction so far, your business model, your financial projections, and kind of Pete was saying, it's the state of your team. Those are the kind of the bedrock that grows up into it when looking at comparables and marketing, your classic slide of total addressable market, service addressable market. That's just connecting your story so far into reality of how things are going in the market. But if we were having to one or the other, I would say put more of your effort into your financial projections, models, and traction than just saying, hey, we're like these similar companies. Most investors will see straight through that. They want to see how you're performing, how you're projected to grow, what you've done so far to inform the valuation.
Yeah, just be careful because you also can't take your financial projections, which are a hopefully a very good science fiction story, and sell them as a perfect justification for a valuation number, right? That is just going to sell investors on the opportunity in aggregate. It's not necessarily going to put pressure unless you've like really unlocked some fundamental innovation in business model. It's likely not going to put pressure on your valuation, but your traction and your team composition and your ability to execute so far, those are things that might.
Cool. Speaking of traction, we got a couple questions about letters of intent. There was one in the chat about just generally what is a letter of intent and what it looks like that would be attractive to investors. And then once we know that, how many is good for traction?
Yeah.
I see you,
So
Ron.
of course, gray areas, but the structure of these things are pretty broad, right? It's literally a letter of intent to do something. What you want to do is get as close to somebody actually paying you as humanly possible, given the state of your company. So if Ryan works in widget production and I am planning an enterprise widget production AI offering, and I go and talk to him and I show him mock-ups and I convince him of where the value add will be, and we talk through a set of features and we write up a document that says, Ryan says, hey, I have talked to Peter at AI Widget Wonders, and if they can deliver a product that covers these basic features, you know, my widget business is willing to purchase it at this agreed upon purchase price in this rough time frame, right? Very, very close to understanding how much somebody in the market is willing to pay for that solution if we can deliver it. There's also a letter of support, which would be Ryan saying something like, hey, I met with Peter at AI Widget Wonders, and I think this idea is really cool and has broad applicability into the market, and we are willing to support this solution through its evolution. All right. Might be interesting to investors, but is farther away from the actual structure of a transaction. So the closer you can get to a letter of intent that shows an intent to buy based on specific deliverables, the better. And then in terms of numbers, there are a variety of ways that you can look at it, right? But usually if you're in LOI territory, you're probably in a B2B market. And usually, hopefully, your price tag for each implementation or each sale is going to be relatively high. So you can look at aggregate volume in total sales revenue of your LOIs. And as always, this is never like a one and done. A key thing to remember as you're working up to your fundraise is that you want to show momentum and progress. So you want to show like a growing top of funnel of LOIs that you are continuing to have conversations adding to an aggregate potential revenue volume of X month over month. Oh, I guess one other important thing. Don't take in so many that if you hit the things that you say you're going to hit, you won't be able to deliver all of them.
I'm throwing some links on some questions on there. Awesome. Brad asks a fantastic question, which I think we might have missed stating. If you have good traction, i.e., revenue and paying customers, why do you need investment?
You don't. This goes back to kind of what we were saying before. Equity investment is super expensive, right? So you're selling a part of your company, you are selling participation and collaboration in that company. You are not just taking money, these people are becoming owners of your company who are going to participate in its growth and have influence on its direction. If you achieve revenue positivity and profitability, and you can continue to finance the company and the growth that you want to achieve based on the money that's coming in, you are default alive and you have all the optionality in the world. If based on that position of strength, you see an opportunity to expand, but you can't do it fast enough with the income that you have based on the existing business, and you don't have the money to finance it yourself, or you don't want to take on debt, or you decide that you're going to aspire to $1 billion company, that is when you would potentially have an opportunity that you would want to pursue that would be worth selling a piece of your company. But it is not a requirement. And software is cheaper to produce than ever before. So if you don't have to raise money to achieve your next milestone, don't.
I said it by myself. There are lots of great examples out there of software-oriented and or technology-based companies that never raised a round or raised one round and went on to become sustainable, profitable, high growth, and et cetera. It's the fundraising of last resort. Chris has got a great question here. Back to safes. Are safes considered equity for the purpose of starting the clock on QSBS?
If you read the most recent version of the YC Safe template, that is what they're trying to do.
They sure
Um,
hope so.
but that hasn't been tested via, as far as I know, via like a no action letter from the IRS or any other um, suit or claim brought against an individual taxpayer. So they are trying to establish that that is the intent, and it's YC. So undoubtedly, they have worked with counsel and tax attorneys likely to have a good argument for why that should be the case. But as far as I know, that has not been tested in any substantive fashion. So the answer is maybe, and hopefully for YC.
Yeah, that's a funny little element of you can write it on a document, but until a ton of precedent and cases have been resolved, you do not know if it's actually going into effect.
But let's see. I version 1.1 of the YC Safe was published what, 2 years ago? And
What
if you
2013 was the first YC safe.
Yeah, but version 1.1 was the introduction of the post money valuation cap.
Oh yeah, that was 2018.
Okay.
And then they updated it 2
Yeah, I think
years
it's like
ago to just
1.3 now. Well, anyway, if you look at that and you extrapolate out to the timelines of YC companies going public, somebody is probably likely to rely on this claim sometime in the near future, but it might not yet be one of the big whales that would invite a lot of regulatory scrutiny. So maybe
yeah, it's
we'll have some
additionally
more information sometime in the next few years.
yeah, I think some of these things, because things take longer than most people say, it's like it's a moot point because even though you might have signed a bunch of safe investors, then they converted to equity investors, and then you got acquired or went public 7 years later. It's a an academic exercise to be like, does QSBS apply? Well, you've held preferred shares for longer than 5 years, so like the safe, whether the safe was binding didn't really matter. I don't know if we've had an Instagram case where a company's gotten acquired, within 2 years of founding and has only pulled in money through safe investors and how that would be
Yeah,
handled.
that's a good point. Yeah, as soon as they convert, unquestionably, as depending on the state of the company, um, as soon as they convert to stock, then as long as the stock qualifies, then the holding period unquestionably starts.
And did we cover QSBS earlier? Sorry, I was answering questions.
No, I don't think we did. But QSBS stands for Qualified Small Business Shares, and essentially it gives a relatively large capital gains tax write-off to people who own and hold shares in private companies early. So most startups, when they are formed as Delaware corporations and don't take an S corp election, start off qualifying for QSBS. And as long as the original holder of the shares holds them for 5 years or more, they can write off up to 10 million in capital gains. And important considerations, it's original holder. So if Ryan grants himself a bunch of stock in his Delaware corporation and then decides to bring me on as a co-founder, but he doesn't have enough authorized shares, so he decides to transfer some of his shares to me, then my shares that I received don't qualify as qualified small business shares anymore, which sucks for me. And if the company goes and issues a bunch of equity and then wants to rebalance it, and they do it by repurchasing a whole bunch of equity from existing equity holders and then trying to redistribute it, they may blow QSBS for the whole company, which your investors will very much not like. So keep on top of that. Great thing to navigate with mission control. if you need to.
And we have a ton of questions on valuation, which I'm going to mark some of them done as I kind of post this. But Gus does have a bunch of tools to help figure out where your company's at, both in terms of how much money it could raise, how it would generally be viewed by investors, as well as what a sane pre-money valuation is. And we actually built that based on probably decades of data now in terms of private company valuations. So I threw into the chat. There's a free tool we call our startup evaluation and feedback engine, which will go through a rather detailed survey and kind of plot you at like what sort of pre-seed seedish stage are you at? Where can you expect to get funds and from what kind of investors? Like I said, that's free. We also have a pre-money valuation calculator that will give you an actual range based on industry stats. That costs 19 bucks a pop. However, unlimited uses of that is included in our mission control program since we're much more high touch in there. So check those out if you're desperate to know information about your valuation and or where funds could come from. And Mark, I hope that answers your question there. As well as Galen asks, what are good formulas to calculate traction into valuation? So if we're looking at MRR or ARR, multiples, etc. It's kind of tough in the early days. A lot of times you're really going to point more towards the market size, your traction so far. Like you will hear often as companies move closer to the public realms. Man, I hate chatbots in my Google Zoom. But when a company moves closer to public realms, you'll start hearing about 6x revenues or something like that being used as a valuation for that. In the earliest days of startups, that stuff usually doesn't apply because your expected revenue growth is so extreme from the early days, doubling and tripling and whatnot, that it's a little less useful. It's more useful to look at your overall market size, your addressable market size, and your projections.
Yeah, I'd say generally, if you are generating under $1 million in revenue on a trailing 12-month basis, then your revenue isn't going to be a good multiple for your valuation.
All right, we've got a bunch more questions that we're not going to be able to get to all of these in time. Any of you wanted to cherry pick, Pete, or anything that you saw that we want to address before we wrap up here?
Yeah. I guess debt versus investment, which one would you take? That's a fun one to end on.
Yeah, I would. Well, it depends on the terms of the debt. I think we said it once or twice that equity is probably the most expensive thing you can sell in your company in a relationship. If you think about, even a single percentage of a company that goes on to be worth hundreds of millions of dollars is very, very significant later on. If you think about the net amount of value, now, there's a lot of things to consider in there, like where that investment is coming from. There are angels who are often very passive angels where they write $25,000 checks and they hope that you IPO or, get acquired in 7 to 10 years. Then there's lead investors who will help you raise a round, who want to introduce you to, advisors for your company who could be good contacts. So there's what they often call smart money that you could get into your company that would be very significantly different than just debt, which is usually an interest rate, a payback schedule, a payback immediately. One of the reasons startups avoid a lot of debt early on is because they burn more than they make. So the idea of paying back the debt that you just borrowed on a monthly basis is very difficult, if not impossible, for startups because you basically locked up the revenue that you borrowed and you can't spend it freely on staffing, advertising, product growth, and things like that without getting endangered and not being able to pay it back.
Yeah, and I think that's another good way to look at it is what the money will be used for. Um, say you have a very well-established advertising channel where you know the economics very, very well. You understand the cost of acquisition, you understand the lifetime value and payback period. Debt is a good option to amp up your advertising spend as long as those metrics hold, because if you add X to that, then it should grow, right? So it is relatively predictable way to extend an existing revenue stream. What it's not necessarily good for is exploratory growth capital, right? Debt is not a growth partner. They're not betting on the future value of the company 6 to 10 years from now. Debt is betting on the ability of the company to pay interest next month, right? So then when you look at, equity investment, you're looking at growth capital, somebody who's willing to collaborate on this for the long haul isn't expecting monthly interest payments, is expecting a big payout if things go really well.
Awesome.
And last one, super quick, Dan's question about traction. Is it better to do a pre-sale or LOI? Pre-sale.
Totally.
Anytime somebody will actually buy it, if you're going to discount the pre-sale, make sure that the discount is in line with the feature set and isn't undercutting the value of the product in the market. But anytime you can actually complete a sale rather than somebody saying, I might buy this later, that is going to be stronger.
Absolutely. Awesome. Well, I'm sorry we didn't get to all the questions, the good questions in there. We will do future events like that. But please, if this stuff is really resonating with you, and you're at the point where your startup could use kind of this expertise and the repetitions is honestly, I think, the biggest part about it. It's hard to hold all this stuff in your head at once, and you're not going to encounter all of this every single day as running a startup. But it all kind of influences each other, as you can see here, like LOIs to pre-sales to traction to forecast to fundraising to valuation, they all kind of support each other. And we're having a ton of fun running the mission control program. It's probably the most hands-on thing we've done at Gust in a decade. So check it out. It's really, really cool. I know some mission control founders are here in the chat and saying some nice things about it. It's a really fun and unique program, and I think it can help a lot of startups get out of that chicken and egg scenario, which I think a lot of founders fall into, which is all I need is an investor and I can run off with this idea. And it's like, oh, but do you have any traction? Like, no, none at all. It's like, okay, well, you're never going to get the one without the other, but how do we reframe your current present so that you can actually start making progress on your business? And I think we're actually pretty darn good at it. But we will send a recording out for this in a couple days when we get it prepped. And other than that, I think we're good.
I think we're good. Thanks for
Thank
being
you.
here.
Yeah, thank you very much, Pete. Good luck with your startups, everybody. And I'm sure we'll see you at another webinar sometime soon.